Hello and welcome to another session of C4S classes where we'll be discussing questions related to finance. So first question on the screen is, what is a promissory note in financial terms? So options are a financial agreement between a borrower and a lender to lend money at a fixed interest rate. Second is a legal document where one party unconditionally promises to pay a specific sum of money to another party at a future date or demand. Next option is a bond issued by corporations to raise long-term capital from investors. Fourth is an equity instrument that represents ownership. And fifth is a type of receipt issued by banks. So here the right answer is B. Okay, so it is a standard definition of promissory note. So what are promissory notes? So promissory notes are written legally binding promise that a one party agrees to pay to agree to pay a specified sum to another party, the payee, either on demand or at a future date. So in this promissory note, the amount is written, even the repayment terms are given, and if interest, if it is applicable, is also given. So these are actually simple debt instruments that people uses in businesses. Okay, so if a person wants to pay back another person, so either he can pay in cash, okay, or he can issue a promissory note that after certain time I'll pay back. So that certificate that gives the this person assurance that he'll get money from him because this certificate is signed by this person. Okay, and this is known as promissory note. Now next question is, what does hedging mean in finance? So first one is investing in high risk assets to maximize returns. Second is selling assets to reduce overall portfolio size. Third is creating a balanced portfolio by investing in various sectors. Fourth is taking an offsetting position in a related security to reduce the risk of adverse price movements. Fifth is purchasing stocks only from stable companies to avoid market risk. So the answer is D. Okay, taking an offsetting position in a related security to reduce the risk of adverse price movements. So let's see what happens in hedging. So let's suppose you have bought copper, okay, today at, this is a hypothetical rate, 1000 per kg, okay. So this is a hypothetical rate. At this time you have bought copper at this much money, and if you think this copper would rise in the future, this rate will rise in the future, so you can take a then you can buy today and you will make profit. Now condition is, at, let's suppose you have to buy the copper after 3 months. After 3 months you have to buy the copper, and you got certain quote that you will get at 1050 per kg. So you agreed to this rate. Now if you found out that in the real situation, if copper prices falls to 900 per kg, then you are supposed to pay 1050 per kg because this is a locked price. So what happens is, this is the position where you are buying copper at 1050. So in derivative market, what you will do, you will take a short position where you will say कि if copper prices reduces to 900, then you will take opposite position. Let's see, here you are buying, then here you will be selling. So this is what we call offsetting position. So in case if you are losing money on a trade, then what you will do, you will take a opposite opposite trade in derivatives so that your losses gets minimized. So this hedging is a risk management strategy that reduces the potential losses. Okay. Now, next question. Under SEBI's September 24 guidelines on credit default swaps for mutual funds, what is the maximum permissible exposure for both buying and selling CDS a mutual fund scheme can have related to its assets? Okay. So earlier, what was going on is mutual funds could buy this CDS. Now, in these guidelines, SEBI has said that they can also sell it. So the amount that has been given in the regulation is 10% of their assets. Okay. So why this is important? Because earlier mutual funds could only engage in the CDS transactions as buyers. So they were only buying the credit swaps. Now mutual funds could also, you know, sell the swaps CDS. So it will increase the liquidity in the market, and this is a step towards increasing liquidity in corporate debt market. Okay, that's why this is an important news. Okay, now before going to next question, this is just a reminder that our UIIC AO exam test series has been launched. The schedule you can find it on our website as well as our Telegram group. Links are given below. Okay. So now next question is, according to SEBI's delisting of equity shares regulations 2024, what is the revised threshold for successful delisting under the reverse book building process? So what is delisting? Delisting is a process where a company who is trading on the stock exchange opts for its removal from stock exchange. That means they are going private. That means earlier their shares were trading on the stock exchanges. Now they are taking or they are buying all the shares that are trading on the stock exchange and they are delisting it from the stock exchanges. Okay. So now SEBI has given a threshold that is required. If that much threshold is really realized, then company can opt for delisting. And that threshold is 75%. Earlier, it used to be 90%. Okay. So here it is given that SEBI's amended regulations have reduced the threshold for successful delisting through the reverse book building process from 90% to 75% of public shareholders' participation, provided that at least 50% of public shareholding has been tendered. What does this mean? That 75% threshold of share value should be there, but in this 75%, at least 50% shareholding. That means, let's suppose there are 10 people. Okay, one, two, three, four. Okay, 10 people, and these three people they control 75% of the share. Now the condition is first condition is 75% of the threshold. That means 75% of the shares should be there. And second condition is at least 50% of public shareholding has been tendered. That means out of these 10, 5 people should have been agreed that they will sell their shares. Then only delisting can be done. Uh, and next question is, according to SEBI's recent mandate effective November 1, 2024, individual investors applying for public issues of debt securities through intermediaries must use UPI for applications of up to what maximum amount? Okay. So, see, the thing is, the answer is here 5 lakhs. So, this question is regarding that earlier UPI limit 5 lakh was there for equity segment. Okay, that means buying of shares. But Now, what this regulation has done is, recent mandate has done is, this mandate has made this 5 lakh limit, even for the segment. That means even for the bonds, if a company is interested in, or if a person is interested in buying corporate bonds, then they can pay through UPI up to 5 lakhs. Okay. Earlier, there was disharmony between the limits of UPI as compared when we were comparing equity with debt. Now they have harmonized, so the value for UPI will be 5 lakhs for both equity as well as debt segment. Okay, so this was the session regarding the finance questions. Okay, so here it is written that it aims to harmonize the process with that of equity and convertible securities. Okay, now by standardizing fund blocking methods, SEBI seeks to simplify and streamline the application experience across different types of securities. Okay, so that's all for today's session. Thank you and have a nice day.